How stupid. We have losers. We have stupid leadership. How stupid are these politicians to allow this to happen?
On April 5, 2025, Donald Trump did what many thought he might, but few believed he actually would. With a single announcement, he slapped a 10% tariff on every single imported product, escalating tensions with allies and adversaries alike. Markets tumbled. Oil prices crashed. The ripple effects stretched from Wall Street to supermarket shelves across the country. The official reason? Protect American jobs. Balance the trade deficit. Punish foreign governments for unfair practices. You've heard those lines before. But something about this moment feels different. More urgent, more chaotic, more calculated. Economists are warning of inflation spikes. Financial analysts are calling it reckless. And yet, Trump's inner circle says this is just the beginning. But why doing this now? Why such sweeping action in a fragile global economy? And why are so many key details being downplayed or ignored in mainstream coverage? This isn't just about trade. It's about control, about elections, about global power shifts. And in the next 20 minutes, you're going to hear what no one else is saying. The real reason behind the tariffs isn't just buried, it's being deliberately hidden. Because once you see the full picture, it changes everything. This is the story behind the headlines. In a surprise move that rocked global markets, President Trump announced a sweeping 10% tariff on all imports, citing national security and economic sovereignty. Backed by the International Emergency Economic Powers Act of 1977, the administration claims this action is long overdue. According to the White House, America's massive and persistent trade deficit is no longer just an economic issue, it's a threat to the country's ability to compete and survive. They argue that the United States has been on the losing end of trade deals for decades, forced to play by rules that others simply ignore. The justification goes beyond basic economics. Officials point to foreign nations applying steep value-added taxes, VATs, on American goods while enjoying free access to U.S. markets. Others are accused of currency manipulation, subsidizing exports, and dumping products at artificially low prices. From this viewpoint, the tariffs are not punitive, they're corrective. They're framed as the first step in restoring balance, protecting American manufacturing, and reviving industries hollowed out by globalization. But the timing and scale of these measures raise deeper questions. Critics, including Republican lawmakers, argue that this isn't just about fixing broken trade policies. It's about securing political capital heading into another election cycle. Senator Ted Cruz has warned that these sweeping tariffs, while popular among parts of the conservative base, could backfire economically and politically. He called them a hidden tax on consumers, warning that price hikes on essentials, from electronics to groceries, could become a daily reality for American families. There's historical precedent to be concerned about. Similar moves in the past, like the Smoot-Hawley Tariff Act of 1930, were followed by severe economic downturns. Economists across the spectrum are raising red flags, predicting retaliation from trading partners and potential supply chain disruptions that could spiral into long-term inflation or even stagflation. But from a political standpoint, this strategy has undeniable appeal. The optics of a president fighting for American jobs against unfair foreign practices play well in key battleground states where manufacturing has declined. At the same time, there's a calculated media strategy unfolding. By framing the move as a patriotic stand, the administration is forcing critics into a defensive position, making it politically risky to oppose tariffs without appearing un-American or soft on trade. This polarization creates a binary. You're either with American workers or you're enabling foreign interests. Behind closed doors, some in the administration admit the broader goal isn't just about economics, it's about leverage. Tariffs offer bargaining power in trade negotiations. They provide a stick to go along with the carrot, forcing allies and rivals alike to the table. And in the meantime, they dominate the news cycle, crowding out other narratives and reframing the national conversation around strength, sovereignty, and self-reliance. The truth is, this move is doing double duty. It's both an economic power play and a political maneuver designed to energize a base that thrives on disruption. Whether it leads to renewed prosperity or deeper instability depends on what comes next and how the rest of the world responds. The markets responded instantly and brutally. Within hours of Trump's tariff announcement, U.S. financial markets began bleeding red. The Dow Jones dropped over 700 points before the trading day even began. The S&P 500 fell nearly 3%. The Nasdaq and Russell 2000 both slid into official bear market territory, signaling a broad and sustained downturn. It wasn't just one sector that felt the impact. Tech, semiconductors, energy, consumer goods, and financials all took major hits. The sell-off was fast, deep, and global. Treasury yields plummeted as investors rushed to safe haven assets, sending a clear message: fear was in full control. A major spike in the VIX, the volatility index widely viewed as Wall Street's fear gauge, confirmed the sentiment. Within 24 hours, it hit levels not seen since the height of the COVID-19 panic. The bond market inverted briefly, a signal that historically precedes recessions, sending economists and analysts scrambling to revise their forecasts. Oil prices collapsed, dipping below $55 a barrel, a level not seen since 2021. The fall wasn't just about lower demand expectations, it was also a response to the anticipated slowdown in global trade and production. Shipping companies revised growth outlooks. Logistics firms warned of upcoming disruptions. The entire framework of international commerce seemed to wobble. Global markets mirrored the chaos. The FTSE 100 saw a 6% drop in a single trading session, its worst day since March 2020, when pandemic fears first gripped the globe. Every single stock listed on the FTSE closed in the red. Asian markets followed suit, with the Nikkei falling over 4% and Hong Kong's Hang Seng Index triggering a temporary trading halt. Emergency statements from central banks in the UK, EU, and Japan signaled just how serious this was being taken globally. In the United States, households began feeling the pressure almost immediately. According to a rapid response analysis from the Budget Lab at Yale, American families could see an average of $3,800 in lost purchasing power over the next 12 months due to rising prices. Imported electronics, household goods, automotive parts, and groceries are all expected to become more expensive in the short term. Middle-class families, already squeezed by rent hikes and healthcare costs, now face a new round of price increases with little relief in sight. JP Morgan revised its forecast and now predicts a 60% chance of a global recession before mid-2026. Its economists are projecting a 0.3% contraction in US GDP in Q4 of 2025, reversing months of cautious optimism that the country had finally stabilized after pandemic-era disruptions and post-stimulus inflation. Small businesses are also reeling. Many rely heavily on imported materials to keep costs down and inventory stable. Now, they're grappling with uncertain pricing, late shipments, and customers unwilling to absorb price hikes. Business owners are being forced to make hard decisions: cut hours, delay expansion plans, or lay off workers. For companies still on the brink after COVID-era shutdowns, this may be the final blow. Investor confidence is crumbling. Institutional funds are rotating into defensive assets. Retail investors are pulling out of growth stocks. Hedge funds are shorting sectors exposed to global trade. It's not just reactionary, it's strategic. The prevailing belief isn't that this is temporary. It's that we've entered a new phase of economic warfare, where unpredictability is part of the policy. Foreign governments are already preparing to retaliate. China is signaling agricultural tariffs aimed directly at red state economies. The EU is reportedly drafting a package targeting US pharmaceuticals and tech services. Canada and Mexico have warned of symmetrical countermeasures. This is no longer just about tariffs, it's a seismic shift in the global economic order. And the consequences are mounting by the hour. Tariffs aren't just about dollars and cents. At the core of the administration's strategy is something much deeper: geopolitical leverage. This isn't simply a reaction to unfair trade practices, it's a calculated shift in how the United States exerts global influence. The White House has been clear about its intent to use tariffs not only as a corrective economic tool, but as a diplomatic and strategic weapon. The administration has floated plans to redirect tariff revenue into a combination of domestic tax cuts and targeted subsidies for the industrial sector. It's a two-pronged plan: spark growth at home while tightening the screws on foreign competitors. Behind the scenes, there are discussions about launching a second wave of America First manufacturing incentives, using the proceeds from import duties to support domestic steel, auto, and chip production. The goal is to fuel a kind of industrial revival not seen since the post-war boom, and to do it without adding to the federal deficit. At the international level, these tariffs are far more than economic punishment. They're pressure points. By targeting countries like China, Germany, Canada, and Mexico with broad-based duties, the administration is creating leverage, pushing nations back to the negotiating table on terms more favorable to U.S. interests. Trade officials have hinted that this aggressive stance is designed to push toward a larger vision, a global reordering of trade norms. That includes reviving the stalled Transatlantic Trade and Investment Partnership, TTIP, talks with the EU, possibly under a new name, and floating the idea of a unified Western free trade zone that excludes adversarial economies like China and Russia. But this hardball approach comes with massive risk. The global economic system is not just interlinked, it's fragile. Markets thrive on stability, and the rapid, unilateral imposition of a global tariff regime has sent shockwaves through investor sentiment. Protests have erupted in multiple countries, especially those heavily dependent on U.S. exports or imports. French truckers have blocked ports in protest of falling agricultural exports. Canadian manufacturers are warning of mass layoffs. German automakers are preparing for losses in the billions. In Mexico, inflation is rising as supply chains slow to a crawl. The broader strategy also intersects with ongoing international crises. In the Middle East, the administration is using trade policy as part of a coordinated effort to isolate Iran economically. By pressuring European companies through secondary sanctions and trade penalties, the U.S. is attempting to cut off Iranian revenue streams indirectly. Similarly, with Ukraine, the White House is leveraging trade talks with NATO allies to accelerate weapons deliveries and reduce dependence on Russian energy, using tariffs as a bargaining chip to gain compliance on broader foreign policy objectives. All of this is happening while the U.S. remains entangled in disputes with China over Taiwan, with Russia over cyber attacks and energy pipelines, and with various countries over currency manipulation. The list of active geopolitical fires is long, and the introduction of sweeping tariffs has poured gasoline on several of them. Allies are rattled, rivals are emboldened, and the line between economic policy and military strategy is blurring. Still, the president appears undeterred. In public statements, he's pointed to previous market downturns during his first term that ultimately gave way to rallies. He continues to frame Wall Street fluctuations as short-term turbulence that will yield long-term strength. Behind the scenes, however, insiders suggest that the administration is keeping a close eye on consumer sentiment, job numbers, and polling in key swing states. The health of the stock market may be seen as a bellwether, not just for economic success, but for political viability. What makes this moment unprecedented is the scale and speed of the shift. Tariffs were once seen as outdated tools of a bygone era, blunt instruments for a 20th century world. But in 2025, they're being reborn as tactical levers in a 21st century chessboard of global influence. This isn't just trade policy. It's economic warfare, diplomatic coercion, and domestic campaigning rolled into one high-stakes gamble. The world is watching, and no one knows exactly how or where it ends. While the administration hails tariffs as a tool to restore American economic power, the fallout for everyday consumers has been swift and painful. Across the country, households are watching prices climb at a rate that few anticipated. The average American family is projected to lose approximately $3,800 in purchasing power in 2025 alone. From groceries to home appliances, from electronics to auto parts, virtually every sector is passing the cost of tariffs straight to the consumer. The impact is not theoretical, it's already playing out in checkout lines and monthly budgets. Retailers are revising product prices weekly. Supply chain delays, compounded by new import restrictions, have driven up operational costs for businesses, which in turn are being offloaded onto buyers. In some industries, profit margins have shrunk so dramatically that companies are choosing between price hikes and layoffs. For consumers, that means not only higher bills, but potentially fewer jobs on the market. Beneath the surface, a more dangerous trend is brewing: stagflation. It's the worst of both worlds, rising prices and stagnant or even shrinking economic growth. Economists at Yale and several Wall Street firms are ringing alarm bells. With the real GDP growth estimate for Q4 2025 now hovering between 0% and 0.5% and inflation rising above 4%, the US is nearing a tipping point. The last time the country saw anything close to this dynamic was in the 1970s, and the economic scars lasted a decade. Consumers are cutting back, not just on luxuries, but on essentials. Grocery chains are reporting changes in buying behavior. Shoppers are trading down to cheaper brands, buying less fresh produce, and delaying large item purchases. Auto dealerships are watching demand cool rapidly. Travel, entertainment, and dining are all beginning to see early signs of contraction. Credit card debt is climbing as people stretch to keep up with basic expenses. In the job market, cracks are starting to show. While overall employment remains steady on paper, job creation in manufacturing and logistics has slowed sharply. Some employers are instituting hiring freezes or trimming hours, citing uncertainty around import costs and demand stability. The narrative of job growth driven by a return to domestic manufacturing is running headlong into a harsh reality. When the economy slows and inflation rises, even protected industries suffer. Meanwhile, small and medium-sized businesses, often the most sensitive to policy shifts, are bearing the brunt. Without the pricing power of large corporations, they're struggling to stay afloat. Owners are juggling higher input costs, hesitant customers, and razor-thin margins. Many fear that if interest rates remain high while prices continue to rise, a wave of bankruptcies could follow. For millions of Americans, this doesn't feel like protection, it feels like punishment. The promise of long-term gain is being eclipsed by immediate pain. As the cost of living rises and wages stagnate, the economic narrative being promoted from the top is growing increasingly disconnected from the daily experiences of workers, families, and small business owners across the country. If this trend continues, the administration's gamble on tariffs may not just reshape trade policy, it could fundamentally redefine how Americans view economic leadership and government accountability in times of crisis. Now you know, this isn't just about tariffs or trade deficits. It's about control, influence, power plays on a global scale with everyday Americans stuck holding the bill. Behind the headlines and press conferences is a strategy built on risk, pressure, and economic disruption, with your wallet on the front lines. Markets are shaken, allies are rattled, and while politicians argue over talking points, regular people are facing real consequences: rising prices, shrinking savings, and growing uncertainty. If this opened your eyes, don't scroll past it. Share it. Drop your thoughts in the comments. Help break the echo chamber and push this into more feeds. We're here to tell the stories others won't, backed by facts they hope you'll never read. Subscribe now if you want more content that pulls back the curtain on the narratives shaping your world. Because when the stakes are this high, silence is complicity. Stay alert. Stay loud. And we'll catch you in the next one.